You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, this episode of Market Champions is sponsored by chartlearning.com. Chartlearning is your go-to if you are an investor or trader looking to improve your trading space. Chartlearning provides canvas art for investors and traders of every kind. Look at this awesome piece of art that I just got from chartlearning.com. You can go to chartlearning.com and get 10% off of any order using the code MarketChamps at checkout. That's chartlearning.com, ChartLatan.com. Hey guys, welcome back to another episode of Market Champions. Today we've got Soueidan from Geo-Investing. He's got about 30 years of experience in the microcap space, both long and short. So thank you so much for being on the podcast.
Hey, thank you so much, Srivatsan. This is awesome.
Awesome. So I want to start off by asking you about your background and how you were actually introduced to investing.
Yeah, it's funny. I tell the story a little different every time because I always remember different things about it when people ask me the question. But there's a few common themes to it. And, when I was, very young, I used to watch my dad kind of play the stock market, if you will. And that's how I first got my first exposure to the stock market. I would watch him, and he would watch every night. He would watch this this daily wrap up kind of report called the Nightly Business Report. It was by an individual named Paul Kangas hosted it. And I used to sit there and watch it with him. I think it was like 7 o'clock at night or 6 at night, and just take it all in and watch, Paul talk to analysts and maybe interview a management here, a CEO here and there, and just give a wrap up of the day. And so I kind of was around it somewhat. My dad wasn't obsessed with it, but he was definitely involved in the market. It got to a point where he actually, though, when he started getting a little kind of more into it, though, he actually would go in the basement and he set up a little stock cave down there and do his research. And once in a while he'd come up from the downstairs basement and come, hey, I found this wonderful little stock. And I'm thinking he's going to say IBM or Intel. And it was this thing I never heard of. And so I just started, seeing this, I don't know what opportunity, but definitely being exposed to smaller companies. He was investing in them and they were doing well. And it even got to a point where I would actually start, working at jobs because I wanted to learn more about the company and from an investing point of view. When I was young, I went to work at a greeting card company that was a local to where we were living at the time because there was a small little greeting card company that my dad was investing in, and I want to learn more about the industry. And but yeah, that's how and then my dad gave me, but the really big inflection point, if you will, in my journey to becoming a full-time investor. I think I was maybe 19 at the time. And my dad gave me the book, One Up on Wall Street by Peter Lynch to read. And I loved it so much. I connected with it. It was written in a way that was easy for a novice to understand. And I was able to relate to it. I read it several times and I was hooked since then. And I just spent my whole, at that time, every day thinking about stocks and, how I was going to make this work. I started participating in investment contests. USA Today used to have a challenge back then called the USA, I think, Investment Challenge. And I would play in those contests.
Did you win?
No, I got pretty high, but never won. I was getting maybe top 20%, but never got high enough. And I was too much of a longer term investor, not a trader. But it gave me a lot of exposure, and it really it was. They must have hated me because at that time, I believe the contest at that time, you would call in to a real broker and put in these fake trades, and that was interesting. So I got that interaction right away. During college, I wasn't kind of getting what I wanted out of the classes. Not knocking college at all, but learning the theory, but I wasn't really learning really how to become an investor per se. A lot of corporate finance. And so I used to, on my spare time, go to the library and read The Value Line, which was a great resource for small to mid to large cap stocks. It's a publication. I think it's still around, and they have an online form now. where they updated every quarter. And it was really, it was awesome because it put a story of a company on 2 pages, maybe like actually a lot of data, a little bit of narrative. It was a very quick way of learning how to do, what these analysts were thinking and stuff like that. And then, so that was my Bible for a while, researching stocks.
Right.
Did a lot of paper trading, paper investing. And I was lucky enough to actually, I don't say lucky enough. I got in a car accident, broke my foot, and I had nothing to do. I was thinking I was lying around all day in my house. And this is the summer, one of my college breaks. And I got a job at a brokerage firm at that time, Dean Witter. My cousin had a friend who worked there, and he had me calling his clientele for selling. I think it was maybe selling bonds or whatever. And he said, "Look, you can just do the calling, get through the list, but use our resources to do the research." So I started really getting exposed to these, to more research, and just really falling in love with it. Realizing I didn't want to be a broker because I wasn't sure what I wanted to do. Did I want to be a broker? Did I want to be a fund manager? And I knew I wanted to pick stocks after not loving the calling process and dealing with that.
Was this like in the early 90s?
This is actually in the probably, maybe late, 88, 92 area kind of thing.
Yeah.
Somewhere in that ballpark. And I just fell in love with it. And I made a decision while I was in college that I wanted to be a full-time investor at some point. And then when I graduated from college, I went to Vanguard, worked there for a couple of years and saved some money up. And I left Vanguard to do it full-time. What was great about Vanguard was they had a part-time gig there, which I eventually went part-time after starting at full-time. And you could work part-time and get full benefits. And they had they had a 4:30 to 9 o'clock shift. So I got an office real close to the Vanguard. So I would invest in trade during the day and then take a 20-minute ride to go to work. So it was an awesome experience. I could work at Vanguard, still get, my paycheck from there while I'm building my investing portfolio. And that's kind of how it worked out. But it was funny when I was at Vanguard. I used to still spend all my lunch breaks, either calling a CEO or doing a lot of stock research.
Right. And so how exactly did you start Geo-Investing? And is Geo-Investing more of like a research business, or is it sort of a hedge fund?
Yeah, Geo-Investing is an investment. I'm not even going to call it newsletter, but it's online research newsletter. And so if you fast forward to 2000, so I went to Vanguard. I graduated college in 92, worked at Vanguard till 94. Until February 94, was just investing in the stock market as a career since 94, really. I consider myself to be a full-time investor during college because I was making a lot of income in the stock market during college too, while I was working on other part-time jobs. And then it was 2007, I launched Geo-Investing, really to kind of bring this nano cap, micro cap opportunity to a broader kind of, network and community. And I thought by doing that, we could build a community and start meeting other investors in the space and maybe sharing ideas. And at first it was a free site, and we eventually made it a premium site in 2013 or 14. And as we did that, we were getting better quality investor into the network by actually charging something. So okay. We're really happy about that. When we launched Geo, it was definitely a U.S. focus, but that was the intent. But then there were a lot of Chinese stocks that were at that time starting to come public through reverse mergers and stuff. Right. And that's something we can talk about later too, the whole China thing. And Geo got involved.
And I forgot to mention in the introduction, you were on the China Hustle documentary, so that's really cool. I really enjoyed the documentary.
Yeah, Geo-Invest. That was China Hustle was about our work along with a lot of other short
Jim
sellers.
Chanos was on it as well. So
Muddy Waters, John Carnes, about the work we all did exposing these fraudulent Chinese companies that were trading in the U.S.
Right. So I wanted to start off with what kind of bargains are you finding in today's market? Today's market, you look at it, you see Tesla flying, you see EV stocks flying, you see basically everything going up. So, what kind of bargains are you finding in this market?
Yeah, it's really hard to when you see that stuff going on to not want to be part of it. You see that, but the tough part about that, from my perspective, like a Tesla or these high flying companies, valuing them traditionally is hard to do, and that's what I've been used to doing. So when you buy stocks like that, I don't know what my exit point's going to be, right? Because you just
Right.
don't know what's going on, right? They're really brands, and it works really good. I'm not saying it's a bad way to invest for some people. It's kind of Peter Lynch on steroids. Buy what you know. but I still do the same thing I did when I started investing, looking for. I've expanded over time, but I'm just looking for companies I can value, understand business plans, understand what they're going to be worth, and kind of understand, downside risk and what the potential upside is, based on the business model and valuation. And when I first started investing, it was very vanilla. It was, hey, I want to find these stocks that are already growing their sales at least 10%, 15%. That was my formula. Growing earnings per share at least 30%. Selling at low PEs of the Peter Lynch approach is, a trailing PE of less than 25 and a forward PE of less than 15. Real clean balance sheets, high return on equity, all the good stuff. And
Right.
back then, the market was a little less efficient. You could pick a lot of these off. But then as I started to evolve as an investor, I wanted to start getting these companies before they look good, before they look pretty, to see if I can find some really, really cheap stuff. And so over time, a lot of my research in stock picking now is finding turnaround stories of these really old legacy companies that have been around for a long time. We call them tier one companies at Geo-Investing,
Right.
Which we have 10 criteria for a tier one. One of them is a very long operating history of at least, I think, 20 years. And that tells us that, okay, this company's been around for a long time. They've stuck around. They've been through a lot of environments, a lot of disruptions, and they're still stuck around. They got revenue. Maybe they're moderately profitable. Just waiting for an inflection point or waiting for something to happen. And we love those kind of companies that always seem to. It can either be that the product evolves, or a new management team comes in to really modernize the company. And so that's a lot of what we look for. But when you're looking at turnarounds, though, or those kind of companies that might not be in hyper growth modes, you value them as they might look really cheap if they're, they have earnings, have sales, but haven't growing. But you got to try and figure out where the multiple expansion is going to be. And then on the turnarounds, you got to figure out, okay, well, they look really bad, right? They look overvalued. And how is that going to change? They're two different challenges, but it's fun doing it.
Right.
But I figured that these turnarounds would really work well for these older companies that have been around for a long time.
But don't turnouts usually have like low multiples because they're usually beaten down and then they're churning around. So that's what's actually causing the multiple expansion.
Yeah, I mean the turnarounds could be losing money too. They could be like a lot of you look. There's a lot of different. We have different buckets of turnarounds. Some of them are companies that are look. They have enough they have good revenue. They're profitable, just not growing. So you don't see a lot of high multiple on that, right? So you're just looking for what is the impetus for that multiple expansion. Maybe it's a new product to come into an established market where you're gonna have increasing margins. Maybe a new management team comes in. But then you have the ones that are losing money that look expensive, right? Because they're losing money. Hold on one second, man. I'm sorry about that. I'll turn that off for you. I'll try to. Yeah, and that's where it's channeled. Now that becomes really, of course, whenever you're looking at any company, you want to understand the business model, understand the risks and opportunities. But when you're looking at turnaround, you got to really dig a little deeper into it. And what I liked about the whole delving into the whole turnaround situation was it made me a better investor because it forced me to look deeper into companies, think longer term, and really improve my process. And that's And that's where we got a lot of our multi-baggers, just finding these young companies, or I'm sorry, older companies that just have turnarounds. It could
What are
be
the other
green.
characteristics of tier one microcaps?
So let me, so you have, I think let me pull it up here because better that I do that than rattle them off, right? I think I have here somewhere. If you give me a second.
Yeah, sure.
Let's see. So the first one is we'd like to have a long operating history. That's really important to us for a tier one. So all these 20, 30, 40, 50-year-old companies just hanging around, waiting for a caps, some kind of really cool thing to happen. Then we have good management. That's really important to us. Is do we have companies that are run by maybe these legacy management teams that know how to have success in the past, know how to bring a company back to growing again, understand the industry that they're in and the markets they're in. We like to have, of course, generating. We're not looking for development stage companies. We're looking for companies that have been around, generating revenue, profitability. We want them to be at or near profitability. Unless it's a high turnaround story, then we're looking for, okay, well, if it's a high turnaround story, we want a high probability turnaround story. So if they're losing money, we'll look at it if we think they can turn things around. We like high insider ownership. That's important to us. We like a clean capital structure or a situation like in a turnaround where it's going to get there. Maybe it's not so clean right now, but it's going to get there. And then we like companies that have we don't like a lot of outstanding share counts. We like low outstanding share counts. Generally we're looking under, the max is 50 million. Usually we're looking at it. Given reasonable revenue, look, if you have a lot of revenue, I know valuation is valuation, but our experience has been in the smaller companies that the smaller share count, the better. And the reason that is, I think, is it basically is a window to a CEO's soul. That if they continue to have to issue shares to grow the company, you need to treat those shares as precious gold, right? Really precious. And it could show that they weren't that they weren't really using their capital appropriately or getting a good return on their raising money and stuff like that. But I will make an exception if a new management team comes in and has inherited a bad capital structure, it wasn't their fault, and they come back and fix it and stuff. We reverse split it and get rid of the convertibles. I'll look at those sometimes too. But I think that was actually 10. So, and we may expand that as we move on. But obviously cash flow is important. Looking at the quality of the balance sheet, all these things are important. But,
and when you look at valuation, do you focus on sort of like future cash flows, use DCF models, et cetera, or do you use net asset models, try and figure out what's on the balance sheet and attach a value to that?
I've always kept it very simple. I used to be used as a PE guy for years, and I missed a lot of opportunities because of that. Now, when I say PE, we adjust the earnings for the funky stuff. We don't like look only GAAP earnings. We'll make our own non-GAAP adjustments. We'll take out all the stuff that's maybe non-recurring, or that we think maybe we think the company is being a little more too aggressive in their assumptions, and we'll adjust the earnings. So we'll use an adjusted PE based on our own kind of approach to investing. And of course, in situations where, I learned over time, the PEs aren't the only way to look at these companies. When I was very young, it was only that. But then moving on, I'm like, some companies, price of sales might be the thing to look at, like in SaaS companies, for example. So I don't. Those are really the two predominant ones I use. And if I'm looking at a deep value stock, of course, I'll look obviously I'll look at the balance sheet and the assets and use that. But regarding using a discounted cash flow kind of analysis, I understand the importance of that and the reasons for doing that. When I'm investing long term, I'm really asking one question: can the stock or can the company be a lot bigger than it is today? Can it be 5 times bigger? And am I going to see improving margins? So I know it's going to be a lot more profitable today than it is, tomorrow in many years. And I'm generally trying to get an idea something like that, because predicting doing a discounted cash flow out to 5-10 years isn't necessarily always gonna be that accurate, right? And there's a lot of assumptions. So I'm more of a qualitative guy. I try to understand the real business model and ask myself, okay, is it gonna be bigger, and are investors gonna really want to really overpay for this one day, where it gets really outsized valuations, right? And that's how I found to work for me.
Got it. No, and there's a famous quote in investing. I don't know who said it, but it goes, superior investing has a lot to do with having a superior process. So as you talked about a little bit earlier, you sort of have different buckets for turnarounds, and even Peter Lynch had them. He had cyclicals, he had turnarounds, he had a bunch of other ones as well. So now, could you sort of go into the details and the nitty gritty of your process, from how you source ideas to how you make a final decision, and what all goes on in the middle?
Yeah. So look, man, when the challenge with investing is it looks daunting at first. Like if you're looking at North America, there's like 20,000 stocks that trade. So how do you have these 20,000? How do you distill that to something that you can manage, right? Is manageable? So the first thing I did was, all right, well, you know what? I'm only going to look at these. Eventually, I made the decision to look at only micro caps and nano caps. So that reduces it to 10,000 stocks in the universe. And then from there, what do you do, right? How do you process? And I'm very anal. I was very hands-on. I like to basically, when I was young, I put it into three different process buckets. How would I distill that universe down? And I did three things sporadically. I made investing fun for myself. So the crux of it for a long time was just tracking new highs, momentum investing.
Right.
Momentum investing is very powerful, I think, and and a lot of investors also feel the same way. You can find value in stocks that are hitting highs too. It just became a way to basically narrow down the universe for me. You just needed a way to do it. I could have done new lows too, probably, but the momentum investing really seemed to work. You find the stocks hitting highs, why they're hitting them, and during that process, you also find short opportunities too. By the way, as you go through that thing, because you find stocks that shouldn't be doing moving up like they are. So that's just gives you a good way of maybe reducing this whole universe to maybe 100 stocks a day or whatever you're, or maybe you can use different price requirements. I would say I was doing new highs with stocks trading under 25, $30, with outstanding share counts less than 50 million. You start really reducing that list. And then I would also at times run screens. I would probably do a screen once, every 6 months.
Right.
I don't love screens because the data, I could never trust the data coming into them. But when I was doing screens, I would do two types of screens. The pretty screen, the ones where I'm looking for the obvious buy, and the ugly screen, putting in things that that would spit out ugly stuff to me.
Right.
That I have to go read every release or filing to find out, okay, well, which one of these ugly ones is going to look pretty eventually.
Correct.
Because a lot of times, back in the day at least, these screeners used to use gap numbers. So they would use these gap EPS can be distorted by gains and losses, and one-time gains and losses, one-time sales, these kind of things. So you got to go and adjust them. And then of course, reading press releases. Now it's readily available. You can all go read press releases. And I basically, at times, will read every press release that comes out on a nano cap, micro cap company during earnings season, or my staff will do it with us. So that's basically the three ways I would kind of reduce the universe. But for the very early part of my career, I would say for the first 20 years, it was just, I would start with a high list, and then from there, from there I would go, okay, here's the high list. And then I would go look at every high that met the initial criteria, look at the related press release, and then if I continue to like it, go read an SEC filing. So that was how I would do it. And then in between that, I would once in a while do a screen. As Geo-Investing grew itself, we were able to get more staff. We were able to read press releases. That's a part of our daily routine. I was reading every press release as part of it too. And the cool thing about reading press releases is that it's a way to get stocks before they hit highs. You can find these turnarounds, and start finding stocks before the momentum comes in, which I love. And one thing I used to do too with the high list was, you could IBD, Investor Business Daily. That's a big momentum. Like Can't Slim, it's all about momentum. And they would have, they would track new highs, and you'd have, and the paper would rank the stocks between like earnings per share, I think a ranking, institutional ranking maybe, and a momentum ranking. And I will look, and so I would look for those that weren't quite there yet. The IBD hasn't ranked high yet, that I thought were going to get high, and try and get them before. And that worked really well too. Probably still would work also today. So that's basically the problem. And then from there, from that initial thing, I'm putting them in buckets. So this stock looks like an interesting core stock that I want to maybe hold in my portfolio.
What do you mean by like core stock?
So basically, a really, I would say a core, no hair on it, looks undervalued. It's obvious that I think it meets like the usual kind of valuation type of scenario framework.
Right.
Love it. Capital structure's clean, and I feel like already I can think of this for potentially holding for the long term. And then in that little bucket, I'll say, okay, well, how many? If I'm looking at these stocks in this core bucket, maybe how many of those look undervalued right now? They go into a sub bucket. They're cheap right now, and those don't look that cheap right now that I kind of want to continue to watch them.
Right.
So that's the core. So that's your basic. So momentum brings those in. Maybe GARP investing. Like the GARP stock will go in this bucket, right? It looks cheap as it is right now. Stocks that maybe have really solid companies that have fallen because the market's falling, give me an entry point. So those real obvious ones. And then I will go into the other bucket, which was more of the I don't even call it a special situation, but maybe these turnarounds. They might not be longer term holdings when I get into it, but I'm holding them because I see some serious catalyst through a special situation that might result in really outsized gains, maybe in the short term.
Right.
Potential, and then a lot of times they become core holdings as you're watching your turnaround. So in there, I'm looking at merger and acquisition opportunities, activism, maybe a business model restructuring, these kind of things, an event-driven catalyst. Some of those non-dilutive offerings. So let me go with those two real quick. So the non-dilutive offering is one of my favorite short-term plays. So when I say the core is mainly my longer-term bucket, which is like probably want to be maybe 90%, 80% of my portfolio. Then around it, I'm doing the short-term stuff to medium-term stuff, which may become long-term. But I'm not really a trader, but I do like to find short-term opportunity. Nothing wrong with doing that, right? And one of the best ways that I had success is these non-dilutive offerings, where a company will offer stock because maybe a selling shareholder has to sell a big amount of stock, and it's not really dilutive. So the stock.
Did you call it a non-deliverable offering?
Non-dilutive.
Dilutive. Okay.
Yeah. So basically, that means is they're not putting new stock into the market.
Right.
They're basically having maybe a investor selling some stock into the market, for example, a big shareholder, and the stock will fall maybe 15, 20%, sometimes 10%, whatever it is. And you can go there after the offering's done, scoop up some stock, and often or not, that stock will rise again. Now, I'm still looking at the company itself, make sure it's a healthy company.
Right.
And even in situations where there are new stock being offered, where it is dilutive, you need to look at what's called the use of proceeds. So in the prospectus, and it might tell you what they're going to do with the money, right? They will. So it can either be boilerplate, hey, we're going to use the money for general corporate purposes, or it can tell you, hey, we're going to pay down debt, we're going to make acquisitions. So this new money could be very accretive, right? And then you want to go in and buy some. So a lot of times that becomes a very way to really sniper off some short-term gains.
Mm-hmm.
The other one I like is these event-driven catalysts, where there's an event going to happen, whether it's a situation where maybe there's a company being priced for bankruptcy because of its balance sheet, and we feel that the company's going to come out of it by restructuring the balance sheet or some catalyst, and that can be a very, very short-term positive catalyst. Those are really two really interesting short-term ones we use here and there. And then we have the other bucket on the bullish. These are all bullish, by the way, is what we call our long shots. And this is where we find out some of our stocks are trading, penny stocks maybe. Everybody thinks penny stocks are all risky and shitty companies, but in reality, there's value in any price if you can find the right company. And because of that assumption, that gives us an opportunity to go find these wonderful stocks because everyone's ignoring them because they've stereotyped them. And we call that our run-to-one model portfolio at Geo-Investing. So we try and find these stocks trading well under $1 that we think are going to really clean companies, clean capital structure that eventually investors are going to find. And we do a lot of due diligence, interview management, look at the business model restructurings if that's going on, and really trying to find these gems. Right. And it's one of our favorite places to hunt because eventually what's going to happen if you find the right one, you buy them, 30, 40 cents, they get to $5. Now the institutions can buy them and they rock from there. So it's amazing how much opportunity is there that investors are unwilling to look at because of stereotypes.
And you sort of a macro cap, nano cap investor, you deal with a lot of penny stocks anyway. So, that it's not risky.
Yeah, well, I wouldn't say it's, look, it's not everything we do. I don't want people to think we're penny stock guys. Right? There's a lot of penny stock crap out there, pump and dumps, but we don't.
Absolutely.
And look, a lot of these stocks, sure, they might be penny stocks for a reason. I mean, they had a bad time, but the management team is finding a way to get out of it. And we're trying to look at that. The more of these opportunities you can find that are automatically ignored by the market is what gives you the opportunity to really get in really cheap at prices you couldn't get into if they looked pretty. And that's fun. And then finally we have this short bearish plays, which we don't do a lot of anymore, but shorting fraud or shorting companies that misrepresent themselves. We don't do much on the short side on business models or valuation because that can take so long to play out, and you can be wrong for too long. There's not enough money in that for us. But if we find a fraud, we want to go short them.
Yeah, it's hard to go short in a market where everything goes up. So
it is really tough. And look, I mean, what short sellers are missing right now, I think, and what's tough, and I'm not knocking short sellers. They do a great thing. They bring balance to the market. They keep companies honest. But when you're shorting stocks on valuation and solvency risk and these kind of things, there's a risk that you're going to be wrong, and you're either wrong in your timing, or that the company's going to do something to get themselves out of it, or a new team comes in and fixes it. But this is really magnified during COVID-19 because a lot of these companies that you would have thought would not have survived or can't survive took the opportunity and the breathing room they got to really right size their balance sheets and clean their balance sheets and
so stock offerings and raising cash,
cutting expenses. So when they come out of COVID-19 here, they'll be more profitable at a lower level of revenue. So it makes it really challenging to be short. And I think in 2021 we're going to see a lot of that earnings leverage come to fruition with a lot of companies that probably would not have survived. It had not been they cleaned themselves up because COVID-19 forced them to do that.
So, and as we go into short selling, I just wanted to talk about China for a bit. So, what was it that attracted you guys to finding fraud in Chinese companies? When did you get started?
Yeah, well, I mean, before we even went short China, we were very bullish on China. I mean, even before Geo-Investing was launched, I was long China, not crazy long, but long a few names. And what was interesting is came across these names. I probably started coming across them in 2000, maybe 4 or 5, and it was amazing how cheap they looked.
Right.
I mean, they were selling at valuations, mouth-watering valuations, growing like crazy. A way to invest in China without having to invest in China because you could buy the stocks here. A lot of them came here through reverse mergers and traded on the bulletin board or OTC. And so Geo-Investing, as it evolved in that 2007 to 8, 9 area, was very long China. And a lot of our stocks we wrote about were in China, and then it started becoming well. And we made a lot of money in China. We going long. Don't get me wrong. But but then it started getting a little bit, you saw these short reports starting to come out. And we started, we didn't rethink what we were doing yet, but we said, you know what, we should really pay a little more attention to these reports and see if there's any kind of merit to any of them.
Right.
And we started looking deeper into that. We sent a kid, actually, there was actually a subscriber to Geo-Investing. At that time it was free. He was a member of Geo. And he calls me up, I talked to him, and he goes, send me to China. I said, at that time, we were already putting together a little China team. I said, so I sent this kid to China with 50 companies to go visit. This is July, I think, of 2010. He called me and said, look, man, they're all frauds. So we suspended coverage on our whole China universe until further notice. And then we said, look, you know what? Let's not be these evil short sellers just yet. Let's go out there and try and fix the problems. We didn't know how bad it really was yet. So we tried working with the investor relations firms, investment banks. Hey, let us help you figure out which one of these companies you're bringing here to the U.S. are fraudulent, which ones aren't. And turns out they wouldn't really work with us. So eventually we said, we're just going to go short. We knew they were frauds. I mean, these were stone cold frauds. So we started really building our on the ground team, and that's how we got into it. And I think we uncovered 14 frauds that we wrote reports on, deep dive reports on, and they got halted or delisted. But there were much. We did a lot more, reaching a lot more names that within Geo-Investing that we didn't write about article wise, that we have brief notes on as we're warning our subscriber base, hey, be careful of these companies. And that's what culminated in part of what culminated in the China Hustle movie.
Right. So, what are the characteristics of fraud, and what were sort of the most common frauds that you got to see when you analyze these Chinese companies?
Well, the fraud game has changed a little bit. So back when we were doing it, between 2009 and 14, or 10 and 14, there were a lot of brick and mortar type of companies. You could go visit them, you could go film them. So it was easy to kind of like find the fraud. So there was two ways of looking for fraud. Initially, you'd look at the filings that they're reporting in the SEC filings, and compare those financials and what they were saying in their 10K, for example, about what they owned, the assets they owned, with documents in China.
Right.
You could cross-check it, and you started seeing a lot of differences in a lot of these things. Assets they claimed to own but didn't own. Numbers 80% exaggerated in the U.S. versus China. So that was a really good, initial way of kind of looking at things. It was basically a lot of document analysis, and then we would send on the ground teams to China to actually start visiting the companies, taking, hitting cameras, and interviewing employees, interviewing people who worked next to the company to find out information. And you would start seeing that companies that said they had these trucks moving in and out of the company all day and making deliveries, they weren't doing anything.
Right.
And they would try to fool you. They would actually show their own tape and would like time loop tape. They're like, well, the same truck you can see going in circles. It was really funny. So anything from not holding a license that they said they owned. So the thing is this: you couldn't trust anything they said. Anything, like 80% of them, the fraud was just so pervasive, didn't matter.
Right.
But now it's a little harder because, a lot of the companies that go public now, there aren't as many reverse mergers, but they go IPO. A lot of them are online businesses, which it's harder to prove the fraud there on the online businesses. So, and look, they're just more savvy. It's harder to get the information that we used to get. China's not cooperating with us on everything. And they're just smarter at doing it. The companies are smarter at the fraud. And what's more interesting, I don't know if this is good or bad, the regulators aren't taking as rough a stance as they were back then. We were doing it. They were halting the stocks, delisting the stocks that were fraudulent. Right now, they're letting the market kind of play it out, which is, I guess, in free markets, it's not horrible, I guess. But there's good and bad to that. I believe in free markets, and we should let price discovery occur. But investors do get hurt by these fraudulent in the end if the fraud blows up, right?
And as you mentioned, the regulators today, Jay Clayton stepped down. So, you have any thoughts on that?
Not really. I don't have no. I don't like. Look, I just don't like. I don't talk much about the regulatory framework too much anymore and what's going to happen. There's a lot of political aspects of the game, and
do you think sort of like a delisting of Chinese companies is going to have any impact, or do you see any opportunity there?
Yeah, I have. Like, it's first of all, it's a 3-year process, right?
Right.
And I think personally, I think that the bill that they talked about really didn't do enough. It's not enough. And what will happen? I guess some possibility that all the good companies will leave, and the bad ones will stay here or try to keep defrauding, I guess. But I think it's too important to the U.S. market. It's too important to the investment banks to not have China involved in our markets anymore. They generate too many fees for these fee collectors, right? And
that is true.
they're a good amount of the IPO flow here. So I think we'll just look at this as a blink in the eye one day, and it'll all be. And I don't even know. Like, and you give a company 3 years to comply. Are you giving them 3 years to comply, or 3 years to get smarter on the fraud?
Right.
And I don't, and I don't know how extensive that the regulators in the U.S. here are going to basically scrutinize what the Chinese companies are saying. Okay, they're going, we passed because this, and this. Are they going to take their word for it? Are they going to dig deep into what they're doing? So hard to say. But look, I would love China to be a place we can invest in. But I mean, look, the problem is even in China. I mean, the companies that trade in China, a lot of them are fraudulent. So I mean, it's really tough. It's a tough minefield to play in.
You still go short Chinese frauds. Carson Black was also in the China hustle. He still puts out a report like every month or every 2 months. So do you still also, still keep shorting companies or?
Yeah, I don't do much shorting anymore. I do it here and there occasionally. We call it more now. We've pivoted more to this risk protection kind of thing, or portfolio protection. I'm sorry, and we let our members know that when we find something interesting that looks fraudulent or looks suspicious, just to be careful about it. But we're not spending a lot of time shorting stocks and going and writing long reports, unless we come across something very, very, very compelling. But we are aware of it, and we make sure that our members are aware of it when it occurs, so we don't get hurt.
Now, why don't you move on to how exactly do you size positions, and how exactly do you manage risk when it comes to position sizing, not making losses too big? When do you take losses? When do you realize you're sort of wrong on an investment?
Yeah, well, the best way I've managed risk is by knowing the company inside and out. It's just being able to be in a position where I can feel so comfortable about the company, where that when things go wrong, do I understand the company enough to know what that could mean to the company? So if something bad occurs, is it an opportunity to buy, or is it time to bail? Now, in terms of position sizing, when I like a company, I take really big bets when I really like. So I don't really waste too much time. So if I see a situation where I see a stock is going to be a 10 bagger, I don't care if I'm paying 20% off for it, right? And then as the stock goes up and the stock gets better, I'll continue to add to my position. And I've had situations where stocks have been up to 30-40% of my portfolio sometimes. It's I'm not saying you should do that. I'm just saying that I do that. I get to that point when I really have high conviction. I would say probably, the top 4, 5, 6 stocks generally are going to be the majority of my portfolio for the most part. And we're talking to members. We're like, a 5 to 7 portfolio for us is kind of pretty of the core of really strong conviction stocks is where we'd like to be. And then around that, trading all the shorter term stuff. What capital a lot of times is a high conviction stock that we don't have a big position in. may become a big part of the portfolio as it grows. And I'm not making portfolio decisions just to size the portfolio. Like if a stock goes from, like 50 cents to $5, I'm not necessarily going to sell it just to make my portfolio look positioned right on the percentage. If I like it a lot, I might even buy more. So that's how I'm looking at it. And I look at more of the risk to my portfolio is more is the business risk. What is the business risk of my portfolio?
Yeah.
And that's how I look at it more. I don't care about volatility as much as I used to. I try to take the emotion out of investing. That's helped a lot in terms of improving my process and my ability to go through volatile markets. And as a full-time investor, I would say one of the biggest things to do really is to and I made a lot of mistakes here but make sure your life is positioned in a way where financially that you can handle big drawdowns in your portfolio. And don't be liberal on margin. And I used a lot of margin when I was younger, a lot. And it got me. It was really great when it was working, but when it didn't work, it wasn't fun at all. So I've learned to curtail that a little bit.
Not use leverage. Yeah.
Yes. I mean, if you're a full-time investor, man, this is your life. I mean, make sure that the emotional game can take its tolls on you.
Absolutely.
And so make sure you position your life and your portfolio in a way where you can handle drawdowns and be confident when they fall to add stocks, actually add to your positions when the market falls.
So, I wanted to sort of start concluding. So you talked today about how you were watching the wider adoption of UCaaS solutions. So could you talk a little bit about what exactly UCaaS solutions are? What sort of the growth catalyst is for 2021? And are there any specific plays that you're looking at in this specific investment team?
Sure. So unified communication as a service. So basically, this is to distill it down to the really the essence of it. It's basically cloud communication. Basically, making it possible for companies to adopt the cloud communication platform or solutions, so that their employees and customers can communicate as freely and effortlessly as possible. Tying everything together: text messages, phone calls, your computer, instant messaging, all those things, and basically putting in the cloud as opposed to on-premise. So the old way of doing it is having a company will license the software, install it at their own location, get all the equipment, everything is hosted at the company, right? Servers, computers, everything. In the cloud solution, obviously you're doing the cloud, so you're basically you're paying a monthly fee to basically use the service of a company that offers you services. So there's a lot less infrastructure cost to a company, and it's a lot. The short-term cost is a lot cheaper than actually buying a whole licensing package, too. So typically, if you're gonna, let's say you could buy let's say you were able to buy a licensed software for $100 million, for example, right? You own it, as opposed to paying a lot less on an annual basis for maybe 3-4 years, where it would take 3-4 years to get to that cost. So it's what that does is it was a great way ability because of the pricing model and everything. It gave access to a lot of smaller companies to be able to adopt these cloud solutions. And when you look at some of the stats, up to 70%, I think, of small business enterprises have not adopted a cloud solution yet, a UCaaS solution. And that was already starting to accelerate the adoption rate. And the market was already a fertile ground, right? Like Ring Central, for example, is a company that plays in that space, or 8x8. These are bigger cap companies. Now, COVID-19 has accelerated the need for UCaaS, the need for these remote communication and the cloud communication, right?
Right.
And so that's just a great driver to accelerate what was already a trend that was going to explode anyway. Mm-hmm. And so we're looking at smaller companies in that space that we think have the ability to not only grow but grow profitably. And there's 2 stocks that we own, or that I own, and that Geo-Investing has provided research on. One is Crescendo Communications, which is CXDO, which recently uplisted from the OTC to the NASDAQ. And then there's another company called Altigen Communications, which is ATGN. And those are the two stocks I mentioned in the tweet. And they're both kind of attacking this wonderful opportunity. And the cool thing about it is it's such a wide open market now that it's okay to have competition. There's just a lot of opportunity to go get some of this market. And what I like about both these two companies too, they're great CEOs, great management. They're profitable. A lot of recurring revenue, which is a big part of these UCaaS companies. And they're attacking it a little differently, each of them. So I like that. So CXTO is attacking the market one way, ATGN is attacking a different way. So two different approaches to it, and they're not really stepping on each other too much. So, and we have research on that at Geo-Investing on both those companies, pretty extensive research.
Of course, for anyone listening, full disclosure, it's not investment advice. So, do your own research before you go long or short those companies. And what are some other investment themes, long or short, that you are eyeing up for 2021? Now, answering your own question.
Look, I put the question there, but to tell you the truth, I'm not really a theme investor. I just thought about that, but I'm really I look at stocks on a case-by-case basis. Sometimes I'll look at non-sexy themes if there's a great company that's changing the way it approaches the way it does business. But look, I'm looking for companies that UCaaS is one area, companies that help their companies that help kind of understand the customer experience more. Because right now, we go through COVID, customers are going to be a lot more, our patrons are going to be a lot more kind of picky what's going on, and more sensitive to things, those kind of things. I like that. I don't know, 5G, maybe, but that's maybe everyone's looking at 5G, right? But no, I'm really looking at mainly companies on a case-by-case basis. And if they happen to fit into a great industry, that's great. If they don't, that's great too. I avoid banking, financials, mining, oil and gas, the resource play. We don't have an edge there at all, so I wouldn't want to invest there. But generally, we're just looking for companies that we think are going to be able to, grow quickly over time. Maybe have the stock grow 10x, 20, 30, 40x over time. And we're holding stocks more with a longer term horizon usually. ATGN we've held since 2015, for example. The longest stock we've held was about 13, 14 years now. So and these are all nano cap companies.
All right. Yeah. So I wanted to conclude the interview by asking you for your top 3 best pieces of advice for investors.
One more time, Shane?
What are your top 3? What are your top 3 best pieces of advice for investors?
Good one. Well, I'll say this. I think that really it's important to, as early on as possible, to get experience in investing. So get started as early as possible. Don't read too many books. Once you connect with something, start putting some real money towards it. Understand that in the very beginning, keep it simple. There's time to get more complicated as you can want and explore these other turnaround stories. In the very beginning, keep it simple. To start to have and try and have success as early as possible, so you enjoy the process. And then as you move on through your investing journey, start adding more complicated things to it, kind of thing. And really, what I think is really important here, man, is understand emotion. Understand how emotion can really negatively affect the way you invest. Step away from the computer. Step away when things are getting really hitting the fan. Turn off CNBC. I don't even watch CNBC anymore. I just don't. I don't. Stay away from all the noise, and spend more time understanding what you're investing in, and saying when things go bad, I want to buy more. I want to be that confident where I can actually buy more of these stocks that are falling.
Absolutely.
And the sell discipline is important too. So when you do sell stock, remember this: that if you're making money when you sell stock, put aside some for taxes, because someone's got to go to taxes. But don't reinvest all of it. Put some in a bucket for a rainy day. that you're gonna use when the market falls, and then and then maybe reinvest the rest of it. So kind of like thing like this. Or if you're a full-time investor, you need some spending money also.
Right. Yeah.
And don't be afraid to take losses, and that's part of the emotion. Because a lot of us, like, we just sit there looking at our losses, feeling miserable, and it paralyzes you.
Mhm.
I always say selling a stock is like breaking up with a girlfriend or boyfriend, whoever's invested, whoever you are, and it feels so. It's tough to do, right? And it's worse thinking about it than actually doing it eventually, and it's healthy. So don't be afraid to sell your losers and ride your winners and buy more of your winners. So more than 3 pieces of advice there, but that's kind of how I will look at it.
Awesome. Thank you so much for being on the podcast, Madge.
Oh, thank you so much, man. I'm really glad that we connected, and this was a lot of fun.
Yeah.
Let me do it again.